They told me the world outside has descended into chaos again. They said that old giant of Japan, which had been slumbering for 30 years, finally sat up from its tatami mat, stretched lazily, and decided to raise interest rates that had been kept low for far too long. And then what? Those gamblers on Wall Street started screaming, scurrying around the trading floors like mice whose tails had been set on fire. What were they yelling? The yen carry trade is going to collapse. Global liquidity is drying up. Sell quickly, run for your lives. Stupid, utterly foolish. Do you think I can't hear all this noise just because I'm lying in the grave? Then you greatly underestimate the hearing of a soul, and even more so, the sensitivity of a value investor to the foolishness of the market. I live to be 99 years old, and I've seen more panics than you've had meals. The Great Depression of 1929, Black Monday in 1987, the 2008 subprime mortgage crisis. Wasn't it the same every time? The crowd rushes around like headless flies, dumping high-quality assets as if they were garbage, just to seek that tiny bit of pitiful security. I've come back today not to listen to you complain about stocks dropping a few points, nor to reminisce about my favorite peanut candies, though they did taste really good. I'm here to jolt you awake, to rouse those who have been muddled by panic with the life experience I've accumulated over nearly a century. Warren is still on Earth, my old partner. He's busy buying things in Japan, like a child picking out the sweetest candies in a candy store. And what about you? You're busy selling. That's simply bonkers. Insane. In this world, only two things are certain: death and the cycles of the macroeconomy. Japan's 30-year, long zero and negative interest rates were unnatural, a violation of the laws of physics, like forcing an adult to crawl on the ground forever. Now gravity has finally returned, and everything is going back to where it belongs. When I was young, Benjamin Graham taught me, be fearful when others are greedy, and greedy when others are fearful. You parrot this phrase, but you never truly take it to heart, while everyone is fixated on what bubble the rate hike will burst. The wise ones, the true value investors, are focusing on what opportunities the rate hike will create. That's the difference. That's why some people can only earn hard-earned money their whole lives, while others can make their wealth compound and grow. You need to understand that panic is a value investor's best friend. During the 1973 oil crisis, people were selling Coca-Cola stock, and we took the opportunity to buy in during the 2008 financial crisis. Bank stocks plummeted, and we increased our holdings in Wells Fargo. Every panic is God handing out red envelopes to those who are prepared. And this time, the red envelope brought by Japan's rate hike might be bigger than you can imagine. All the smart people I've met in my life read every single day, without exception. Not one of them didn't. And what about you? You stare at the candlestick charts on your phone screens every day, led around by short-term fluctuations. Yet you're unwilling to spend even an hour understanding the power of macro cycles or thinking about the essence behind interest rate changes. Success requires great calmness and patience, but also sufficient aggressiveness when opportunities arise. Now, the opportunity is right in front of you, yet you're stepping back. Today, using my 99 years of experience plus a little bit of worldly wisdom, I'm telling you, once Japan truly enters a rate hike cycle, there are three types of assets that are God's gifts to you. They're lying there like gold on the beach, waiting for someone to bend down and pick them up. If you miss out, don't blame me for not warning you. Only blame yourself for lacking courage and foresight. Before we talk about what to buy, I must first give you a lesson on mental models. Because if you don't understand the why, even if you buy the right assets, you'll get off the ride halfway due to fear. That's why many highly intelligent people make terrible investors. They have character flaws and can't control their irrational emotions. First, we need to think using reverse thinking. What is reverse thinking? It's turning problems upside down. Invert, always invert. Why has Japan been stagnant for the past 30 years? The answer is simple: deflation. Imagine when people think things will be cheaper tomorrow than today. What will they do? They'll postpone consumption and hide their money under the mattress. Businesses will postpone investment and deposit their profits in banks. The entire economy becomes frozen. Without flow, there's no growth. But now this logic has reversed. Inflation is back, according to data from the Bank of Japan. The current year-on-year increase in core CPI has reached 3%. Food prices and energy prices are on the rise. And more importantly, the transmission effect of wage increases is becoming evident. The Japanese Trade Union Confederation has set a target of wage increases of over 5% by 2026. Corporate profits are at a high level, giving them ample ability to raise salaries. When people realize that money will depreciate tomorrow compared to today, they'll start spending. When businesses realize that investment can yield higher returns, they'll start expanding. What does this mean? It means money is starting to flow, and the gears of the economy are beginning to turn. You need to know that Japanese companies are the most honest, yet also the most conservative in the world. Their balance sheets are as clean as a blank sheet of paper, with huge amounts of cash sitting on them. Japan's private sector holds as much as 2,043 trillion yen in financial assets, equivalent to 4 times its GDP, 53% of which is in the form of cash or deposits, compared to only 13% in the United States for the same category. Toyota Motor alone holds 23 trillion yen in excess savings, equivalent to 3 years of its total net profit. In the era of zero interest rates, this cash was dead money, a burden, and even cost money to hold. But in an era of high interest rates, this cash is ammunition, seeds that can generate more money. We always say to buy mispriced bets. Right now, the entire world's pricing of Japan is still stuck in the perception of recession. That's the biggest mispricing of all. People remember the devastation of the 1989 bubble burst and the lost 30 years. But they fail to see that Japan has undergone fundamental changes now. First, corporate governance reforms are driving improvements in the quality of listed companies. The Tokyo Stock Exchange has clearly required listed companies to raise their ROE to an 8% standard, which means businesses must use capital more efficiently instead of letting cash sit idle. Second, the restructuring of global supply chains has brought new opportunities for Japanese companies. Related exports are continuing to rise, driven by global AI demand, and automobile exports, while volatile, remain at a high level. Finally, the endorsement from my old partner, Warren Buffett, has brought confidence to the market. He first bought shares in Japan's 5 major trading houses in 2019 with an investment cost of $13.8 billion. Now their market value has risen to $23.5 billion, and he's still increasing his holdings. This is a classic positive version of the Lollapalooza effect, multiple forces overlapping to produce enormous synergies. The return of inflation plus corporate governance reforms plus Buffett's endorsement plus the restructuring of global supply chains. Together, these factors will drive Japanese assets into a decade-long upward cycle. This isn't my guess. It's a judgment based on historical patterns and data. I've lived through many cycle transitions in my life, and I've never seen such clear signals. Japan's economy recorded its first negative growth in 6 quarters in July-September 2025. But this is just a temporary pullback, mainly a natural decline after front-loaded exports due to spring tariffs. Looking at a longer cycle, the annualized real GDP growth rate from April to September 2025 reached 0.9%, higher than the potential growth rate, and the trend of moderate economic recovery remains unchanged. Bank of Japan Governor Kazuo Ueda has also made it clear that he will gradually raise policy interest rates. This isn't hitting the brakes, but gently letting off the gas to achieve stable growth. Think simply and act earnestly. This simple truth is mean reversion. No economic state lasts forever, neither recession nor zero interest rates. Japan has been stuck in the quagmire of deflation for 30 years, and now it's finally going to climb out. Those who mock Japan are like mocking a giant who has temporarily fallen, forgetting that giants will eventually stand up. So stop fixating on the ridiculously overvalued Nvidia. They're indeed excellent, but their valuation already reflects all positive expectations. Look east. Look at Japan. There are undervalued assets, imminent potential, and gifts from God for value investors. Outright, take out your notebooks and write this down. The first type of asset is so simple that even a kindergarten child can understand it, yet Wall Street PhDs always turn a blind eye to it. And that is, Japanese. You need to understand the essence of the banking industry. What do banks live on? Net interest margin. NIM, net interest margin, is the ratio of a bank's net interest income to its average interest, earning assets, reflecting the bank's ability to generate interest income using interest, earning assets. Simply put, it's the difference between the interest a bank pays on deposits and the interest it earns on loans. For example, if a bank pays 0.1% interest on deposits and charges 1.5% interest on loans, its net interest margin is 1.4%. Over the past 30 years, Japanese banks have been practicing in hell. The central bank set interest rates at zero or even negative levels. Banks barely had to pay interest on deposits, but they also couldn't earn much interest on loans. Net interest margins were squeezed to the limit, falling below 0.3% in some years. They could only struggle to survive on meager fees, foreign exchange transactions, and overseas investments, like travelers searching for water in the desert. But now, things are going to change. Once the Bank of Japan starts raising interest rates, even just from 0% to 0.5%, or even 1%. Do you know what that means for banks? It's not a matter of profits increasing by 10% or 20%. It's a matter of profits doubling or even tripling or quadrupling, because their deposit costs will remain extremely low. Japanese people's savings habits won't change easily, and huge amounts of capital will still sit in banks, but loan yields will soar immediately. Let me do a simple calculation for you, no calculus needed, just elementary school arithmetic. Suppose a Japanese bank has 100 trillion yen in interest, earning assets. In the zero interest rate era, with a net interest margin of 0.3%. Its annual net interest income is 300 billion yen. If the net interest margin expands to 1.5% after the rate hike, annual net interest income becomes 1.5 trillion yen, a five-fold increase in profits. This isn't a fantasy, it's basic arithmetic, a certain gain. It's like a person who has been starving for 30 years suddenly being invited to a royal buffet. How much can he eat? He'll make up for all the meals he missed in the past 30 years. Japanese banks are just like that. They've been starving for 30 years, and now they're finally getting a chance to feast. Look at their valuations, too. The current price to earnings P ratios of major Japanese banks are only 6 to 8 times, and their price to book PB ratios are even less than 1 time. That means you can buy 1 yen's worth of assets in the bank vault for just 80 cents. And now that 1 yen can generate even more small change. This is an unparalleled valuation level among bank stocks in major global economies. Compare that to U.S. bank stocks. During the Federal Reserve's rate hike cycle, the average gain of U.S. bank stocks exceeded 50%, directly driven by the expansion of net interest margins. Japanese bank stocks have had their valuations suppressed for 30 years due to zero interest rates. Now that the rate hike cycle has begun, how much upside potential do they have? I won't say they'll double, but there's at least 50% room for valuation restoration, not to mention the premium from profit growth. Japanese banks not only have low valuations, but also excellent fundamentals. Leading banks like Mitsubishi UFJ Financial Group, MUFG, and Sumitomo Mitsui Financial Group's FMFG have sound risk control systems and extensive overseas business layouts, with stable income sources in Asia, Europe, and the Americas. They've weathered 30 years of deflation without collapsing or experiencing large-scale bad debts, which shows their extremely stable operations. More importantly, Japanese banks are the main holders of Japanese government bonds. The Japanese government has a huge amount of debt, but most of it is held by domestic investors, forming a closed loop. Banks hold large amounts of government bonds, and when interest rates rise, bond yields increase, boosting the value of banks' assets. That's an additional source of income. I don't like predicting the macroeconomy or the specific path of interest rates, but I know basic arithmetic, the laws of human nature, and the power of mean reversion. When the cost of capital rises, lenders are the winners. This is a trade that doesn't require high intelligence to understand a certain investment. Many people will say that Japan's severe aging population means insufficient loan demand. That's true, but they overlook two key points. First, corporate investment demand is rebounding. Japan's corporate investment plan is set to grow by 10.3% in fiscal year 2025, focusing on R&D and labor-saving software. Second, overseas loan demand is strong, and Japanese banks' lending business in Asia is growing rapidly, which can offset the shortage of domestic loan demand. Others worry about banks' bad debt risks. But you need to know that Japanese companies have very healthy balance sheets with ample cash, so their default risk is extremely low. Moreover, in an environment of inflation and economic recovery, companies' profitability will improve, their ability to repay loans will strengthen, and banks' non-performing loan ratios will decrease, not increase. I've invested in many bank stocks in my life, and Wells Fargo is one of my most successful investments. Back then, no one was optimistic about the banking industry, but we saw the potential for net interest margin expansion and room for valuation restoration. Now, Japanese bank stocks are facing the same opportunity, even a better one, because their valuations are lower and the potential for net interest margin expansion is greater. So my advice is, buy shares in leading Japanese banks and then go to sleep. Don't stare at stock price fluctuations every day. Don't be influenced by short-term market noise. When interest rates normalize and the market realizes the value of Japanese bank stocks, you'll thank me. This is an investment that requires no risk but yields substantial returns. That's the essence of value investing. All right, let's talk about the second type of asset. You actually already know this one, because my old partner Warren Buffett has already done the homework for you. He's been busy in Japan these past few years like an explorer who's found a treasure trove. But he might not have told you the deeper logic why in a rate hike and inflation cycle, these seemingly dull trading houses are more reliable choices than tech stocks. They are Japan's general trading companies Sogo Shosha, Itochu Corporation, Mitsubishi Corporation, Mitsui and Company, Sumitomo Corporation, and Marubeni Corporation. These names sound boring, right? They don't have AI chips, no metaverse concepts, and their official websites are even old-fashioned and stodgy. But I'm telling you, these companies possess the most precious things in the world, irreplaceable real assets and a steady stream of cash flow. First, understand one question. What exactly do these trading houses do? Simply put, they are the blood vessels and nerves of Japan's economy. From iron ore mines in Australia to oil fields in the Middle East, from farms in Brazil to convenience stores in Southeast Asia, from chip raw materials to electric vehicle components. Every breath and every heartbeat of Japanese society is inseparable from them. Mitsubishi Corporation's business covers four major sectors: energy, metals, machinery, and food, with revenue accounting for 2.3% of Japan's GDP. Itochu Corporation controls 15% of global cotton trade and 70% of Japan's beef imports. They are not single enterprises, but global commercial empires spanning the world. Why should you go all in on them during a rate hike and inflation cycle? I'll give you three irrefutable reasons. First reason, they control core resources and are direct beneficiaries of inflation. Inflation is essentially a process of currency depreciation and physical asset appreciation. When prices of oil, natural gas, metals, and food rise, who profits the most? Not the factories that manufacture products, but the giants that own, transport, and trade these resources. These trading houses are like toll booths of the global economy. No matter how high prices rise, as long as people need to live and businesses need to produce, they have to pay these tolls. This is the strongest economic moat, far harder to disrupt than any patented technology. Second reason, their dividend policies are more reliable than church oaths. In a rate hike environment, the valuations of growth stocks will be ruthlessly suppressed by rising interest rates, because future profits will be diluted by higher discount rates. But high dividend value stocks will become safe havens for capital. The average dividend yield of Japan's five major trading houses has remained at 3.5% minus 4.5% for years, and they haven't cut dividends for 20 consecutive years. More importantly, the Tokyo Stock Exchange's corporate governance reforms require them to improve shareholder returns. These trading houses have begun to respond by repurchasing shares and increasing dividend ratios, and their dividend yields may exceed 5% in the future. In an era of rising interest rates, receiving stable and growing dividends is more valuable than gambling on a stock doubling. Third reason, my old partner Warren's moves have demonstrated what genius level arbitrages looks like. Do you know how he invests in Japanese trading houses? Using Berkshire's credit rating, he issues yen bonds in Japan with an interest rate of only around 1%, then uses this low-cost capital to buy trading house stocks with a dividend yield of about 4%. What does that mean? He's essentially using Japanese people's money to buy Japan's core assets, earning a net interest spread of 3% every year. And that doesn't even include the gains from rising stock prices as trading houses' profits grow. As of 2025, this investment has brought him a floating profit of over $9.7 billion US, and he's still adding to his positions. You might not be able to issue yen bonds, but you can follow suit and buy the stocks. This isn't blind following, it's standing on the shoulders of giants. Warren has spent decades studying global markets, and every large investment he makes is the result of careful consideration. He chose Japanese trading houses not on a whim, but because he saw the same things I did: undervalued intrinsic value and upcoming cyclical dividends. I know many of you like chasing tech stocks with flashy names and compelling stories, but I need to remind you that those unprofitable companies that rely solely on concept speculation will burst like bubbles during a rate hike cycle. When the dot-com bubble burst in 1999, the Nasdaq index fell by 78%, and those once celebrated star companies have long since disappeared. Meanwhile, Japanese trading houses at that time, though also affected, quickly recovered thanks to their stable cash flow and real assets. The essence of investing is buying assets that can generate cash flow in the future. These trading houses can send you checks every year, protect your purchasing power during inflation, and remain stable amid economic fluctuations. This is the kind of investment that lets you sleep soundly at night. They're like old oxen, quiet and unassuming, but they can steadily carry you to your destination. So stop being obsessed with those glamorous concepts. Open your brokerage account, look at the stock price trends of Itochu and Mitsubishi Corporation, check their price-to-earnings ratios 10 to 12 times and price-to-book ratios 0.8 minus 1.2 times, and compare them to those tech stocks with P/E ratios of hundreds of times. Smart investors know which to choose. Now, let's talk about the third type of asset. This one is the most special. It's not stocks or bonds, but currency itself, the yen, or more precisely, yen-denominated assets, including yen cash, yen deposits, and Japanese index funds, without hedged exchange rate risks. Look at the current exchange rate. The USD FEJPI once broke through 150 in recent years, and while it has pulled back somewhat, it's still near a 30-year high. Many people say the yen is finished. Japan's economy is going to collapse, and the yen will become worthless paper. This is another classic linear thinking trap, a sign of ignorance of history and economic laws. There's one of the most powerful forces in financial markets called mean reversion. It's like a rubber band stretched to its limit. No matter which direction it's pulled, it will eventually snap back to its equilibrium position. No currency depreciates forever, especially the currency of a developed country with massive net overseas assets, leading technology, and a complete industrial system. Japan's net overseas assets amount to as much as 359 trillion yen, ranking first in the world for 30 consecutive years, equivalent to each Japanese person owning 2.8 million yen in overseas assets. These assets bring Japan over 20 trillion yen in investment income every year, more than the total value of Japan's automobile exports. This means Japan's economic fundamentals are far more solid than you think. The yen has depreciated not because Japan's economy is weak, but because the U.S.-Japan interest rate differential has continued to widen over the past decade. The Federal Reserve raised rates while the Bank of Japan maintained zero interest rates, so capital naturally flowed to higher-yielding dollar assets. But now the situation is reversing. The Bank of Japan has started raising rates, while the Federal Reserve's rate hike cycle is nearing its end, and it may even start cutting rates in 2026. When the interest rate differential begins to narrow, those speculators who have been shorting the yen will close their positions like an avalanche. Imagine trillions of dollars flowing back from the dollar to the yen. Which way will the yen go? Only one direction. Up. This isn't my guess. It's a historically proven pattern. In the 1990s, when the U.S.-Japan interest rate differential narrowed, the yen appreciated by 30% in 2 years after the 2008 financial crisis. The yen, as a safe haven currency, appreciated by 25% in a year. This time, the magnitude of the interest rate differential change is even greater, so the yen's appreciation potential will be larger too. Buying yen now is essentially purchasing the purchasing power of a developed country at a 50% discount. Let me give you an example using the Big Mac index. A Big Mac costs 5.50 in New York and 650 yen in Tokyo. At the current exchange rate of $1 to 140 yen, a Tokyo Big Mac is equivalent to 4.64, 15.6% cheaper than in New York. If the yen appreciates to $1 to 120 yen, a Tokyo Big Mac becomes about $5.42, roughly on par with New York. This means exchanging dollars for yen now to spend or invest in Japan is like getting a 15% discount. For investors, buying Japanese index funds without hedged exchange rate risks means earning two types of returns: asset appreciation and exchange rate appreciation. Suppose Japan's stock market rises by 50% over the next 5 years and the yen appreciates by 20%. Your total return will be 80%. and that's a conservative estimate. If you buy hedge funds, you'll miss out on this huge additional gain. I know some people will worry, will the Japanese government intervene in the exchange rate? Of course it will. But intervention can only affect the exchange rate in the short term. It can't change the long-term trend. Back in the day, the Japanese government joined other countries in intervening through the Plaza Accord, but it still couldn't stop the yen from appreciating. The power of trends is unstoppable, and the law of mean reversion is unbreakable. Investing in the yen doesn't require complex analysis, just common sense. When something is extremely undervalued, when everyone is bearish on it, and when its fundamentals are undergoing positive changes, that's the signal to buy. When I was young, no one was optimistic about us cigar butt stocks. But that's when Warren and I bought them and earned dozens of times our investment. Now, the yen is that overlooked cigar butt stock. But it's not a cigar butt, it's a piece of gold covered in dust. So my advice is, convert part of your dollars, euros, or Hong Kong dollars into yen. Deposit it in a Japanese bank. Japanese deposit rates have started to rise, and some banks' time deposit rates have reached 1.5%, or buy ETFs tracking the Nikkei 225 index or the Topix index without hedging exchange rate risks. This is like taking out insurance for your investment portfolio. It can preserve value during inflation and profit from exchange rate rebounds. I've talked a lot over these 40 minutes, from macro cycles and mental models to bank stocks, trading houses, and the yen. But fewer than 1% of people will truly listen and take action. It's not because my words are hard to understand, but because of human weaknesses, chasing gains and selling losses, being eager for quick results, and fearing being. Many of you are over 50 years old. You've worked hard your whole life and accumulated some wealth. What you need most now isn't to take risks gambling on the next 100-fold coin or chasing concepts that even their founders don't understand. Instead, you need to find high probability, low risk opportunities to protect your savings and let your wealth grow steadily to support your later years. Japan's rate hike is exactly such a high probability opportunity. It's a safeguard handed to us by the macro cycle. Bank stocks provide interest income. Trading houses offer inflation protection and stable dividends, and the yen provides an option for exchange rate appreciation. Together, these three form a perfect anti-fragile portfolio. Whether the economy is in moderate recovery or accelerating inflation, whether interest rates rise slowly or adjust rapidly, this portfolio can resist risks and generate returns. I lived to 99 and saw countless people fail because of greed and fear. They rush in when the market is crazy and flee when the market panics, chasing gains and selling losses their whole lives, ending up with nothing. Meanwhile, successful investors are those who understand patience and discipline. They buy when others are fearful and sell when others are greedy. After buying high-quality assets, they hold them for the long term instead of being led around by short-term fluctuations. Warren and I have held Coca-Cola for over 30 years and Wells Fargo for over 20 years. We never sold because of short-term stock price fluctuations, because we knew the value of high-quality assets would eventually be reflected in their stock prices. Investing is like growing fruit trees. You need to water and fertilize them and wait patiently to taste the sweet fruit. If you try to pick fruit right after planting the sapling, you'll never get to eat it. Right now, Japanese assets are like a fruit tree that has been planted for 30 years. It didn't bear fruit before because of deflation. But now inflation is here, interest rates are rising, and there's plenty of sunshine and rain. This fruit tree is about to have a bumper harvest. Buying now means entering right before the harvest, requiring little additional waiting to reap substantial rewards. Don't wait until all the media start praising Japan's economy to enter the market. By then, stock prices will have already risen, the exchange rate will have rebounded, and the soup will be cold. The core of value investing is buying when others haven't yet discovered value and selling when everyone realizes it now. Is the time when others haven't discovered the value. I know making choices that are different from the crowd takes courage. When your friends are talking about Nvidia and Tesla, telling them you're buying Japanese bank stocks and trading houses might lead them to mock you for being conservative and outdated. But remember, in investing, the opinions of the majority are often wrong. Those who mock you may be paying the price for their greed. Finally, I want to leave you with 2 words: patience and discipline. These are my most valuable investment lessons in life. Patience lets you wait for opportunities, and discipline lets you seize them. The opportunity brought by Japan's rate hike may come only once a decade. Seize it, and your wealth will take a qualitative leap. Miss it, and you may have to wait another 10 years. I'm Charlie Munger. Even though I'm no longer in that world, my wisdom will always be with you. Remember, you don't need to be a genius to get rich. You just need to avoid being foolish and outlast others. Here, outlast doesn't refer to lifespan, but to investment lifespan, to how long you can stay rational and patient in the market. Go look at the opportunities in the East. Buy those undervalued assets and embrace the power of mean reversion. I believe 10 years from now, you'll thank the decision you made today. Goodbye, my friends. May your investment journey be free of greed and fear and full of rationality and patience. May you all protect your savings and live a stable and happy life.